Good afternoon, everyone. I want to take the time to welcome everybody here. I just left drug court graduation. It was my first time attending. So if I had a word for the day for the mayor, it would definitely be opportunity. These are people that have been struggling with addiction, and they go through some alternative programs to avoid lengthy jail time, and they're given an opportunity to learn how to be sober and to learn how to contribute to the community in a productive way. So opportunity has definitely been on my mind as our word of the day today. We are here thanks to our library team for helping to coordinate the event, the Key City CDC with Dave Beer and Jake Lee, Frank Kaler from the City of Kankakee, who serves as our economic development director, and of course the support of our economic alliance led by Tim Nugent and Lisa Wogan. So in the climate that we live in today politically, most people, particularly when you look at the national level, will probably say there's not a whole lot of good things going on. But out of that administration has come some legislation that's going to have a significant impact on the city of Kankakee. We are designated as an opportunity zone, and you'll find out what that means more in a bit. But we are the only municipality in the county that has a significant portion of land that is dedicated as an opportunity zone. And 2 years ago when I became the mayor, you know, a lot of people look at Kankakee and talk about our challenges, and I want us to be defined by how we address our challenges. So this is a tool that we can all use, that we are encouraging developers and investors to use to come into our city so that we can grow our community, which is what we all want to do. So without further ado, I will bring up Jake Lee. And Jake is the youngest of 5 children born in Kankakee, Illinois. He grew up primarily in Hopkins Park, was educated at Pembroke and St. Anne Public School Districts. After high school, he joined the U.S. Navy and served at several duty stations. Jake, has an associate's degree in business administration, a bachelor's in business administration, and I believe a master's degree as well. Upon his return to Kankakee County, he got involved in the community. He supports several organizations through his volunteering efforts. In addition to the degree earned while on active duty, he also has a bachelor's degree in accounting from Governor State, a master's in business administration from the University of Illinois at Chicago. Sounds like he likes to collect degrees. Jake was elected Kankakee County Auditor in 2016, and he has 2 daughters, Brianna and Maya. So I'll go ahead and bring Jake before you at this time. Thank you.
Thank you very much, Mayor. Thank you to all of you who have joined us this afternoon for this wonderful event. I want to start off we've got a lot of great people in the room today, and we want to recognize our elected officials who took time out of their schedules to be with us. And I want to start with Alderwoman, and please hold your applause until I'm done. I know people love to clap for everyone, but please. Alderwoman Carmen Lewis of the 5th Ward of the City of Kankakee, Alderman Mike Prude of the 1st Ward of the City of Kankakee, of course our esteemed Mayor Chastity Wells Armstrong of the City of Kankakee. We've got Mayor Tim Nugent of the Village of Manteno, Alderman Fred Tedder, 7th Ward, City of Kankakee, Alderman Michael Bryan, 2nd Ward, City of Kankakee, Alderman Carl Brown, 7th Ward, City of Kankakee. Alderman Chris Curtis, City of Kankakee, 6th Ward. Dwight Reed, not sure of your position, Dwight, but you know what? Oh, okay, these aren't elected officials on there. All right, and then we have, that's okay, you know, we've got it. And then we have myself, of course, County Auditor of Kankakee County. Stephen Hunter is a retired alderman, and retired alderman Dennis Barron has joined us as well. So please give our elected officials a round of applause. Thank you very much for being here. I would like to acknowledge our sponsors who helped make this event possible as well. Of course, the City of Kankakee. This could not be possible without them. We'd like to thank the library as well for the space and the support that has gone into this event. Midland States Bank, the Economic Alliance of Kankakee, Key City Community Development Center, and the Kankakee County Chamber of Commerce. So if we could please acknowledge all of our sponsors with a round of applause. We'd appreciate that. So let me briefly tell you about the Key City Community Development Corporation and what we stand for and why we're here. So we were created to help facilitate transformational growth in the city of Kankakee. And because there has not been development in various areas such as the north side, the east side, and other areas other than our downtown, which has grown tremendously over the past several years, as you all can attest to, we felt it was important to have an organization that would be citywide and would be able to help facilitate this wonderful mechanism that you'll hear about called the Opportunity Zone that exists now in the city of Kankakee. Our mission is to cultivate quality of life improvements through long-term, sustainable economic growth in areas of tourism, entertainment, culture, business development, home ownership, while maintaining the uniqueness of Kankakee. We do not want to change who we are, the spirit of this community, as we grow and develop. We want to keep that uniqueness here because we are a very special community, and we want to make sure that Kankakee stays the place that people want to grow up, they want to live, they want to work, and they want to have leisurely activities. I'm going to, in the interest of time, because I want you to really be able to soak in what our attorneys and our accountants have to present to you, which is the real meat of the event today. I'm going to skip to basically our four pillars, which is business, housing, education, and economic development. So with those ideas is what we want to do as a community development organization. And this event is going to talk about how we can foster those activities through the Opportunity Zone mechanism that you'll hear about. So without any further ado, we're going to get to the real technical portion of this, and that is with Mr. Scott Stick from SKDO, which is Smith Kelling, Dykstra and Ohm accounting firm here locally, and he is going to bring to us the real benefits in terms of taxes and other benefits of the Opportunity Zone. So, Scott, if you would, please. And can we give him a round of applause as he comes? We really appreciate Scott being with us today.
Thank you, Jake. First, I want to say thank you for the opportunity to have me here and talk about this opportunity that is for the city. I mean, there's nothing but good things that can come from this. However, how did we get here? This way. Oh, okay, I see. There we go. The tax law that came out in 2017, this new tax law, the Tax Cuts and Jobs Act, basically allowed this opportunity to take place. The proposed regs, the first round, did not come out until 2018. The latest proposed regs came out last month. This is still developing. There's still a lot of unanswered questions, but luckily the last set did help quite a bit. The first set was 73 pages. It basically gave the outline of what this will do with us. The second set was 168 pages. It basically answered 10 questions that everybody had. After the first set, all tax practitioners were able to send in questions, what they wanted further clarification on, definitions, etc. These 10 questions helped out quite a bit, and I'll touch on some of those. Now, this is still there's a lot of things in a gray area still. Obviously, everybody's still learning. It's something that the city of Kankakee has not, I think, grasped yet, because not everybody knows about it, or the benefits that come from it. So hopefully this event will help out quite a bit. But because I only have about 20 minutes or so, I can't get into all the scenarios. In fact, the proposed regs I have sitting up on the table there's quite a few pages. But by all means, after the event, and even if we go down the road afterwards, I will be able to answer most of your questions. Some of them I may be able to defer later if I'm not quite sure on it. But another person to reference is Karen Benson, who's sitting down here. She as well, she's a manager at SKDO. We'll be able to help you out with whatever we can, and if not, we'll get back to you later. What I want to speak about today basically is how we got here and what can you do with the investment side of it. If I'm the investor, and what can you do as far as the recipient, if you actually wanted to put action with this. The investor and the recipient of these funds can be the same person. They don't have to be separate. So how did we get here? Obviously, back in 2017 is when the new tax law came out. The opportunity zone basically has outlines on what zones or what is eligible for these zones. And a lot of them are based on, obviously, economically deprived communities. But even more so, it's based on income, median income for that location. And there are differences between rural and urban communities. After that, each state, basically the governor's office, had the opportunity to basically choose the zones. I'm not quite sure. I mean, most states, the communities went to the governor. The governor basically said, okay, this is what we're going with. Each state was only allowed so many zones. It wasn't a free-for-all. After that, because the IRS was dealing with the new tax law, the U.S. Secretary of Treasury basically verified everything and approved all of these zones. As of this point in time, all 50 states, U.S. territories, the District of Columbia, they all have opportunity zones designated. The City of Kankakee, obviously, here's the map that is on the state website, the Illinois Department of Commerce and Economic Opportunity. To the west is obviously the river. The east is the interstate. North is, for the most part, Brookmont and Grinnell. The south, it zigzags a little bit, but for the most part, we're looking at Maple and Eagle. So what can we do with these? Obviously, we need to know who can participate. Who are the investors that can, participate and get these tax benefits? They have to have eligible gains. They have to be an eligible taxpayer. We'll get into these in more details next. What are the benefits? Why would I participate in this? What do I get out of it? How do I create these? I mean, other than calling an attorney like Dave and saying, help me, what is it that we need to do to actually get this done? And then as far as what can be contributed and when, there are obviously anything with the IRS, there's restrictions. We'll get into those. So who can invest into an opportunity zone? QOZ, Qualified Opportunity Zone. Any individual cannot participate. You have to have capital gains. Capital gains, most individuals, you hear that word and you think, okay, I sold something for a profit. Well, yes, that is the case, but it needs to be taxed as a capital gain. Now, on the 1231 is basically anything that's going to be taxed at 0% or 15%. 1245 and 1250 do not qualify. What a lot of individuals, I guess, I want to clarify is if I bought something for $100,000, it's been depreciated down to $50,000. I sell it for $150,000. Okay, I have a $100,000 gain. However, that's not all capital gains. That recapture, that 1245, that original $50,000 from your 50 to back to your 100 does not qualify. It's the $50,000 after your original investment that does qualify as capital gains and does qualify as an investment into the opportunity zone. That's, if you guys have questions on individual situations, talk to your EA or CPA. The tax has to be recognized before 2027. That date is significant because that's when the Tax Cuts and Jobs Act actually expires. So the scenario that I see that actually occurring in is installment sales. You have an election to pay the tax up front, you need to do that, otherwise it may not all qualify. And obviously, it can't be a related party. You can't sell to a family member and expect everything just to be all great. An eligible taxpayer. An eligible taxpayer, as we have listed, is basically anybody paying tax. Individuals, C Corps, S Corps, partnerships, estates, trusts. The unique part about it is the S Corps and partnerships. For those that own those entities, you know that flows through to your personal return. You actually have the option to either elect to keep that within the entity and reinvest in the opportunity zone, or pass it down to the shareholder or the partner, and they would invest into the opportunity zone. You have that option. What are the benefits? Why would you do this? The biggest three, obviously, are deferral, reduction, and elimination of taxes. Deferral, what is that? If I have capital gains on my return, I invest into the opportunity zone credit, I don't have to pay tax on that right away. You defer it. The reduction. The purpose of this program is to help communities. They don't want you to invest and turn around and pull back right away. If you sell it before 5 years, you basically don't have a benefit. However, if you hold those investments inside the zone for 5 years, you get a 10% reduction on that tax. After additional 2 for 7 years, you get an additional 5%. So 15% of your original tax is now gone. The little slide, the little bullet point there is, the reality is it's deferred. It's not gone. 12/31/2026, you're going to pay tax on 85% of your original investment. However, if you hold it beyond that time period, and you hold it for at least 10 years, you can eliminate any gain beyond that of the original investment, not everything. So if I have $100,000, I put it into the opportunity zone credit or opportunity zone. After 10 years, I go ahead, I pay my 85% tax. I sell it for, $500,000. If I don't put any other additional sources into that, I have $400,000 that's tax-free. But you need to put that money, and it needs to stay there. That's the whole purpose of this program. So how do you create this? Surprisingly, it's easy. It's very easy. Other than talking to an attorney, an accountant, the tax side of it is very easy, almost too easy. It's the second thing that I've ever gone through that I feel like the IRS has made it too easy. Basically, it's 2-page form that you have to fill out with the tax return. You do not have to get specifics on it. However, make sure you talk to your attorney, and in the Articles of Incorporation, you have specifics in there so you avoid issues in the future. I foresee the IRS coming back and auditing quite a few of these. On the form, you don't even have to say what zone you're participating in. I could be an Illinois taxpayer participating in a California zone, and nowhere do I have to state that. Obviously, it needs to be an S Corp or a corporation or a partnership. You can be a shareholder, obviously holding interest in those, and that's how you're going to participate, unless the corporation itself held on to that tax, and therefore they're the ones actually participating in it. The Form 8996, here's the first page. Part 1 is general information, nothing specific, but you do have to fill out a few questions. Part 2 is basically, we'll go over this multiple times. It's this 90% test. Of your investment, you have to keep 90% within the zone. You can't, this is the whole point. You want to keep that money in there. They want you to keep that money in there. If you pull out more than 90%, it's dissolved. Then you have to pay a penalty. Part 2 basically goes through every 6 months, the 6th month and the final month of the year to test this 90%. If the 90% fails, that's what page 2 is. Page 2 is month by month, you need to list the assets and the qualified assets, and per month, they'll catch you. So it's fairly simple. However, you need to stick to the rules. It is important to list out what month you actually participate, because obviously the IRS, they're not dumb. If you if you create an opportunity zone prior to the gain that you have, well, then how can you do that? not possible. So it is very crucial that this form is filled out right. Obviously, contact your accountant to get that taken care of. When can you contribute and by when? Now, I broke this slide up into two different parts, the proposed regs and the latest regs. Under the proposed regs, it does not specifically state what you can put in, but it assumes that it's all cash. I mean, you sold something, you should have some cash coming in. However, the latest proposed regs basically say you can actually contribute property. Now, the reason that's significant is because it does free up cash. If you have a piece of property, if you have equipment that you want to contribute into this fund, it's possible, and you still have cash outside to fund other things or actually have additional money in this fund or in the business that you have. You still obviously need to meet the 90% rule. That does not go away. Now, one of the issue that everybody had at first was, well, you have 180 days to basically contribute those gains into the fund. So if I sell a piece of property, I make $100,000 in, let's say, May. I want to go ahead and contribute. I have 180 days to do that. However, by the end of the year, I have a stock on hand that went through a merger and it was sold. I didn't have a choice. That creates a loss. Now, if I have a $100,000 loss that offsets that gain, I don't have any gain on my tax return. I contribute to the fund because I need capital gains. If you have a good broker that does harvesting in December, he may not know what you're doing with your other capital gains. He may harvest some stocks, therefore create some losses, help you out on your tax return. He's doing his job. He's being a good guy. However, it may eliminate some of the gains you had prior and that are eligible for this fund. So a lot of the questions the IRS received was this 180 days. What can we do about it? Well, in the latest proposed regs, they basically said, well, you have 180 days now from the last day of the fiscal year. So most of us are calendar year. Most corporations, partnerships, obviously, are calendar year. I have 180 days from December 31st to contribute. But be careful if you have a corporation that has a June 30 fiscal year end, you start on June 30. Your 180 days begins then. So you have just after Christmas to basically reinvest those funds. That was a common question that I'm glad they addressed. Now to switch over to the recipient. If I'm one that's receiving these funds, what can I do? We're going to talk about the opportunities that we have. And basically, they're qualifying property, businesses, and business property. There are some businesses that are prohibited. The IRS wants to shy away from a few of those. Some of them call it the sin businesses. And then basically, what is a trader business? That gets into the latest proposed regs, and they actually do clarify a few things for us because otherwise there was questions all over the place. So, qualifying property. Obviously, property is the business property that you may be investing in, stock, and then partnership interest in a partnership, obviously. The 90% test, obviously, we touched on that previously, but you need to make sure you have 90% in all property that you have. It needs to be the original investment that you have. You can actually add to it, but you just have to be careful what you add to it. With the latest regs, there was a question that was answered as far as contributing cash. And if you contribute cash at year end, it may knock you out at 90%. Well, as long as somebody contributes cash, but they have yet to actually do much with it, it has to be cash, cash equivalents, or debt, then you're okay. But you have to spend it and do something with it shortly thereafter. You have a 6-month limitation on that 90% rule. I don't foresee that happening too often, but it is an option, obviously, with these new regs. Then you have a qualifying business. Especially in Kankakee, what I see a lot of individuals doing is taking these funds and actually creating a business or starting a new business with themselves. With their own money. They know Kankakee. I see a lot of individuals doing this. There are a few different, obviously limitations on this. The biggest ones are the 70% test, the income and asset test, and the qualifying businesses. The 70% test. is obviously 70% of tangible property that is either purchased or leased has to stay within the zone. The 50% gross income test. That was another one that was hit on with the new regs, because what is 50%? What do you say 50% of your business is? Well, there's 3 safe harbors with that. 50% of the hours spent by the employees have to stay within the zone. 50% of the amount paid to either employees or independent contractors have to be paid for services that are spent within the zone, or tangible property located within the zone, and the management and operational functions that generate 50% of your gross income have to be within that zone. That one I see as a gray area that I see audits from in the future. But those are the 3 safe harbors that they actually came up with when trying to justify or tried to clarify this 50% gross income rule. Then obviously, a substantial portion, which they clarified to be 70%, of intangible property must be used within an active trade or business within the zone. I foresee most Kankakee Opportunity Zone benefits being from the business aspect of it. Next slide here, obviously the last one is business property. This property needs to be purchased obviously after the Opportunity Zone was created, and there's basically 2 items that need to be followed. The original use of the property needs to begin in the zone. Now, original use, what's that? The IRS defined original use as any tangible property that was put into service to be depreciated or could be depreciated in the zone. We'll get back to that. Or there has to be substantially improvements in that property. Well, if I buy a piece of property, what that means is I have 30 months to basically double my basis in that property. You need to put money into it. You need to improve it. Now, we're not talking about fair market value. We're talking about basis. So if I put $100,000 in, I need to put $100,000 into that building, double my basis within 30 months. That 30-month time period is a sliding 30 months. It's not just when it starts. 5 months later, there's still another 30-month period where you just need to continue to improve it. The last item we have here is prohibited businesses. These are the sin businesses, as some would call them. I'm not going to say much about them. Some of them make sense, but obviously they want to see improvements. They must feel there's enough of these out there. The IRS, thankfully, defined trade or business. Those of you that are business owners have F corps, partnerships, et cetera. What is a trade or business has been a question that's been around for years now when this new tax law came out. The qualified business deduction that some of you may know about through your own businesses, this was a heavy topic. What is a trade or business? Luckily, they clarified that a little bit more to match that deduction. So basically, what's the biggest part of it? Well, rent. They say you are allowed to collect income from rent, and it does qualify in the Opportunity Zone. However, you need to be active. Now, it's a little bit of a gray area, but triple net leases, avoid those at all costs. A triple net lease is basically you pay the real estate taxes, insurance, and collect money. I mean, there's no active participation. You're doing nothing. Well, if you guys do invest in some of those, make sure that you contact an attorney to rewrite the lease, and so there is some active participation there. Otherwise, it will not qualify. And then one last thing. The proposed regs talked about buying property or into a business inside the zone. Well, the latest regs basically said, well, you can now lease property. For example, the biggest benefit I foresee is a qualifying business. If I own a qualifying business, I have X amount of capital gains, I want to start this business. Well, if I have to buy a building, that's going to cut into my cash flow. So the IRS basically said, okay, you can lease a property inside the zone to basically establish yourself inside the zone. That's all right. Well, if you talk about leased property, the substantial improvements, they remove those. because you don't own the building, you don't have to basically double your basis in it, but that business can now operate outside of or inside that zone and basically qualify. That, again, I foresee Kankakee using quite a bit. So, obviously, we don't have time for question and answers, but catch me afterwards. You could also talk to Karen. I have some business cards if you guys have to go and we need to talk later, that's absolutely fine. But otherwise, I'm going to turn the mic over to Dave, and we're going to move on. Thank you.
Thanks a lot, Scott. So what we wanted to do today was have an opportunity to go over the very fine details of opportunity zones. As you can tell, it's a lot of accounting, it's a lot of legal standards, but this is a tool. Opportunity zones are a tool. It is useless unless the people of Kankakee, unless the investors of Kankakee County know about that tool, know the standards of that tool. So the idea is here, you take these home, and we'll send these slides to you. Don't worry if you haven't been taking notes of all of the accounting standards. We'll give you all the slides, but let it percolate. Think about what types of projects you have or what types of capital gains you have that might qualify for this program. A lot of the attention that's been put on opportunity zones up to this point has been about massive projects. When Amazon was talking about building their H2 headquarters in New York, that was going to be an opportunity zone project. It was going to be funded by opportunity zones. A lot of the other attention is about big multi-unit projects, which are important, and we're going to hear about some great ones. But this tool isn't only accessible to those massive projects. It's also accessible to smaller projects, to single-family rehabs, to putting up a 2-unit apartment building, to putting up a business incubator. I'm going to go over some of those things as well. I'm focused on smaller projects. I do want to start, though, as all attorneys should, with a disclaimer in saying that use this only for educational purposes. Anything that I say, I do advise you to speak with another attorney or a consultant or an accountant at some point along this. These are broad general standards. If you want to get into details, please do talk more specifically with an attorney. Just a little bit, I want to glaze over some of the facts that were talked about a minute ago. In terms of what you have the possibility, this slide here is why opportunity zones are gaining such a buzz throughout the country and why they should be gaining such a buzz in Kankakee. Based on the standards that Scott talked about, if you had $100 in capital gains and invested them into a qualified opportunity fund, you kept that investment there for 10 years, assuming that the opportunity fund then invested into a project that gained 7% appreciation for 10 years, if you compared a stock portfolio, which also appreciated at 7% per year, after tax, 10 years later, if you look at the stock portfolio, you'll get back $132. If you took your investment, the $100 in a qualified opportunity fund, and you get it back after 10 years, you're going to get $176. Quite a bit of difference. That's why this is gaining such a buzz. That's why we hope that you will take a close look at some projects that might work. One thing that Jeff Bennett and I have talked about before is how do you monetize this? How do you know exactly how much you can stand to benefit from an opportunity fund and an opportunity zone project? I would advise you to check out this opportunity fund tax calculator. This is where you can actually put in your numbers, your statistics, your figures, and figure out what might actually be possible for you to return at the end of 10 years. Scott mentioned briefly the process for putting together an opportunity fund is very simple. It's a 2-page standard. Here are a number of different types of opportunity funds that you're probably going to see out there. Outside investor funds. It doesn't need to be Kankakee investors that invest in the Kankakee Opportunity Zone, nor does it need to be Kankakee investors that only invest in the Kankakee Opportunity Zone. It can be throughout any of the 800 opportunity zones that are out there. Local investor funds, if you have a fund that is just made up of people locally within the county, within the region that want to invest in Kankakee projects. You're going to have funds that are billions of dollars have been raised in capital funds. You're also going to have funds that have raised thousands, tens of thousands, hundreds of thousands put into an opportunity fund. Over on the other side, the two distinctions here. One, pooled fund. You don't need a single investor. You can have a lot of people come together with their capital gains and put them into a fund that is created. Or you just have a single investor, one person who has capital gains and they want to create their own opportunity fund themselves. Second one, you can have a fund that invests in several projects, several businesses, several properties. Or you can have an opportunity fund that is solely focused on one property. I think that in order to make this as simple as possible, we should take a real good look at the single investor funds and the single project funds. We can do a pooled fund, but it gets a little more complicated. As Scott mentioned, you have to hold the investment for 10 years. Then you have to get everybody who is pooled into the fund to agree to that 10-year restriction. So it gets a little complicated. Not that it can't be done. And if you got a group that want to talk about it, let me know. I'm happy to think about a pooled fund. But a single investor fund is something that could be done relatively easy. Also, too, if you have a single project that you have in mind, you can create an opportunity fund to do that. And as Scott mentioned, I mentioned again, all these different types of funds, the 8 different types of funds here, all self-certify using the same exact IRS form, the 2-page form that went through a minute ago. Many of you might be familiar with a 1031 exchange. This is something that I do in real estate law quite a bit. It is a mechanism, it's a feature of capital gains law where you are able to defer any capital gain that you have on your current investment holdings, and then you buy a like-kind piece of property and defer the capital gains onto that next property. It's a way to save money, defer the capital gains down the road. I think that if you are ever looking at an opportunity, if you're ever looking at a 1031 exchange for your transactions, as simple as they may be, it might be one piece of property you sell in order to buy a new piece of property, you should give a serious thought to whether or not you can do an opportunity fund to gain some of that benefit as well. Here are some of the differences between 1031s and opportunity funds. A couple of them you'll go over very quickly. With the 1031, it has to be real estate for real estate, and not just real estate, it has to be investment real estate for investment real estate. For an opportunity fund, you can sell your stock and whatever capital gains you get there. You can sell your residence, and you can use the capital gains there. So there's more opportunities to reap the capital gains benefit in the opportunity fund. With a 1031 exchange, you have to put the entirety of what you sold into the new property. So let's say that you had a piece of property for $500,000. Let's say $500,000, you sold it for $500,000. You would have to put all of the $500,000 into new property in order to take advantage of the tax deferral. You're not going to get any cash at the end of it without having to pay some tax on it. But with an opportunity fund, if you sell your $500,000 piece of property, let's say your capital gains there are $100,000, you're going to invest the $100,000 into an opportunity fund, and then you have $400,000 that you get to keep in your pocket. So you do free up some cash in a way that 1031s don't allow. Both of these programs have a step-up basis upon death. With the 1031, that's typically the idea. You just hold your property and keep transferring your basis from one property to the next until somebody passes away, because then the step-up basis goes all the way up to the value of the property at the time of death. That happens too with a opportunity zone investment. If somebody does pass away, their investment does transfer on, they do get the step-up basis for the heirs of the opportunity fund investment. So I do want to talk about, I'm going to give you 3 examples of ways of small projects that an opportunity fund really makes available. The first one is a residential rehab. Simple, buy a piece of property, fix it up, and then rent it out for a good amount of time. The way you do that with an opportunity zone, opportunity fund situation is, let's say that there is a property manager, maybe there are some property managers here, they create a new LLC which certifies as an opportunity fund. Then they get capital gains, whether from themselves or whether from somebody else, but they get capital gains and inject it into that new LLC, that new opportunity fund. They can also put into that fund other sources of funding. It doesn't just need to be capital gains. It can be debt. It can be a pocket change that they have. Then that fund purchases a single-family residential property and substantially improves it, as Scott talked about. That means you have to double the basis. If you buy a property for $50,000, you got to put another $50,000 into improving that property. Then the manager receives regular income from rent over time. After 10 years, if you keep that property, there will be no capital gains tax on the appreciation to that property. Recently, the new IRS regs that were mentioned previously allow you to sell that property and then buy a new piece of property within the opportunity zone if you do that within 12 months. That's a new piece that really opened things up. Same process, this is for a residential rehab, but it's the same process that you can look at if you want to do commercial properties, mixed-use properties, or if you wanted to have not just a single family, but you want to have a 2-flat or a 3-flat. I mentioned a minute ago what happens in terms of comparing a stock investment versus an opportunity fund investment, and that was assuming that there would be a 7% return on the property. That'd be 7% appreciation. I do want to point out this statistic over here, this graph that's on the right. What this shows is in the city of Kankakee for the past 3 years, the median sales price for single-family homes using traditional sales. So no foreclosures or anything like that, just a traditional sale. In the past 36 months, that piece of the median price has gone up 47%. Okay? So 7% is feasible. In the past 12 months alone, that figure has increased, the median sales price has increased 21.2%. So when we're thinking about possibilities, that is a good thing to keep in mind, that this could actually work in terms of 7%. And you're not paying any sort of capital gains on increases above what you initially invest there. Second thought you might have is a business expansion. Some of you might own businesses already that want to take advantage of this program. To do that, let's have an existing business who creates a new LLC. They qualify it as an opportunity fund, and then they put in capital gains. Hopefully they have their own capital gains to put in to make this easier. That fund then purchases some new real estate where they want to start operating. As Scott mentioned, it can also be equipment that they need. But they purchase real estate that is in the opportunity zone, and they substantially improve it. Put in double the value. That fund essentially serves as a holding company for the business and allows them to lease the property and use it going forward. Taking advantage of a single project fund with a single donor to put together an expansion of a business right there. Third, startups, new businesses. If I could ask, how many people here came because they are looking to be entrepreneurs? They're looking to receive some of the funds from an opportunity fund. Anybody here? Okay. All right. So the idea with this would be, and this is simple, it just goes over what we talked about previously, have sort of an opportunity fund that serves as an angel investor that provides the initial startup capital. The way they do that is they create a LLC that serves certified as an opportunity fund and then that opportunity fund purchases the stock of a new business or a new operation. That's how you infuse capital into the entrepreneurs that we have here today in order to make them go forward. Another possibility for startups is to do an incubator. And that, for purposes here, go back to my example one where you talk about creating an LLC for a single project, make it an incubator, and you have the tenants, which are new startup businesses. So again, it's the same sort of process there. So those are some of the smaller projects. The next thing we're going to talk about is larger projects, and we have 3 different people who are speaking on that. Frank Kaler is the Economic Development Director with the City of Kankakee. Tim Nugent is President and CEO of the Economic Alliance of Kankakee County. And Scott Snavely, who is Regional President of Midland States Bank. So thank you.
Thank you. I just want to talk about Kankakee basically from 20,000 feet and kind of giving an indication of what's going on and what some of the unique situations are. First, I'll understand there's no special or separate permit from the city that's required for an opportunity zone project. Unlike TIF, which may require a redevelopment agreement, or the enterprise zone where you have to work through the county on that, the benefits of the opportunity zone are really between you and the IRS. So, but the city is very excited to have a designated opportunity zone, and we think it creates a new window for development and reinvestment in the city. The city has adopted a riverfront master plan recognizing the significance of the Kankakee River as a national water trail and envisions a myriad of public improvements, including lighting on key bridges, streetscape enhancements, a whitewater run, kayak canoe launches, festival entertainment venues, linear bikeway and pedestrian walkways, pavilions, gardens, and other improvements. With the growth that's going on in the region, and I think Tim Nugent will be talking about that, there is unmet demand and sites, for market rate multifamily, duplexes and townhomes, mixed-use residential, commercial, office buildings, senior citizen housing, corporate offices, R&D facilities, small to mid-sized manufacturing, industrial uses, distribution, logistics facilities, restaurants, hotels, and much more. What makes the Kankakee Opportunity Zone so exciting is the prospect to layer the zone benefits with other programs. The city is in the process of creating a TIF district within the downtown, tax incremental financing district. There's already in place a TIF district for the shops at the Meadowview Shopping Center on Kennedy Drive in Brookmont. Many areas within the zone are also in the Kankakee River Valley Enterprise Zone, and the benefits that go along with that. Select properties can also benefit from historic tax credits and the prospect of new market tax credits. This is the proposed boundaries for the TIF district in the downtown. And so, just one final comment. Kankakee is an historic, vibrant, and active riverfront community. We continue to transform into an extraordinary place to dream, grow, and thrive. Embracing our diversity, we aspire to be progressive, inclusive, and innovative, and we invite you to join with us. Tim?
Thanks, Frank. And what I'm here to talk about a little bit is not what's happening specifically in the city of Kankakee, but throughout the whole county, which the city of Kankakee is obviously at its core. There's a lot of great things that are going on in the region, and because of that, it's a great time to be able to have an opportunity zone and be able to invest in the local area. Last year, Kankakee County, MSA, Metropolitan Statistical Area, was rated the #1 growth metro in the United States. Now, I'm not talking Illinois, I'm not talking central United States, I'm talking the United States of America. Out of 394 metropolitan statistical areas throughout the country, Kankakee was rated #1. This is like winning the national championship of job growth, and not everybody knows the things that are happening here. Who would have ever thought, 10 years ago, that this area would be growing jobs at the rate that we are now, to the point where we're being recognized in national magazines throughout the United States as the #1 job growth area in the whole country. It's something that is unheard of for this, for the region, and everyone thinks that everybody's leaving Illinois. Well, that might be the case, but the people that are here are staying and they're getting jobs at rates that we've never experienced in the last several years. There's a lot of different things that we have that are happening throughout the county. Over the last 4 years, we've had over $1.7 billion in major capital investment. We hear a lot about Nucor Steel's investment, about CSL's investment, and a lot of the major companies. But there's lots and lots of small companies throughout the area, throughout the county, throughout the city of Kankakee that continue to make huge investments to the point where I say over the last 4 years, $1.7 billion. And now there's been announcements from CSL and from Nucor over the next several years that number is going to continue to rise year after year. So we're talking billions of dollars that people are investing in Kankakee County. We're the #1 small metro in Illinois for job growth and tech growth for 5 out of the last 6 years. We've been recognized by Forbes magazine as one of the best places for businesses and careers. #8 in the USA for the cost of doing business. And it's economical to live here. We're at 92% of the U.S. average for the cost of living here in Kankakee County. So you can get jobs here, you can get good paying jobs here, you can have careers here. The old days where the kids used to graduate from high school and go away to college never to return, those can change now. They can come back here and have careers for the next 10, 20, 30 years at jobs that are good paying, where they can raise a family and have a great life right here in Kankakee County, right here in the city of Kankakee. And the city of Kankakee is right in the middle of it. They are obviously the largest metropolitan area, largest city in the county. They've got a number of different things going for themselves as far as having a historic downtown district. They've got the Riverfront Master Plan, a medical corridor, government and civic center, employment and entrepreneurship hub. They are a community gateway. They've got market rate multifamily residential demand. There's been a study made where a few years ago when the downtown apartment complex was going to be built, a study was done showing the need for at least 800 potential rental units in Kankakee. They've got a lot of different activity, and that because of the job growth in the area and because of the needs that the city has for its unmet growth, there's a good reason for opportunity funds to invest in this area. And the city of Kankakee is the only one in Kankakee County that is designated an opportunity zone. So they are the only ones that can be the recipient of the opportunity funds. Obviously, as Frank talked about, they've got the Riverfront Opportunity Zone, which is going to be going on over the course of the next decade. But throughout the whole region, we are also touting the Route 50 commercial corridor, where there's a lot of commercial activity there, and the CSL project is going on. Bourbonnais is a Parkway development area. So there's activity throughout the region, and all Kankakee, the city of Kankakee, is really at the center of it. And these are projects, and these are things that are going to continue to happen. So if people have capital gains and they want to invest it, why not invest it in a region that has got a lot of jobs, that is very economical to do business? It's at the center of the country, and it's got a lot of plans for expansion and growth. And when the Riverfront Opportunity Zone and the Riverfront project gets going and starts to look like this, who's not going to want to be there? You've seen the map already of the Opportunity Zone and the area that it covers in the city of Kankakee. And on our website for the Economic Alliance, we've got over 40 properties that are located in the Opportunity Zone that are available for purchase. We will be able to continue to update those properties at our office. So anytime you want to go and see what's available for purchase in the Opportunity Zone, you can go to the Economic Development website. You can click on here and find out what properties are available. And like I say, we'll continue to update it. And you can also find out all the specifics as what realtor has it, all the different specifics about the potential properties that might be for lease or for sale. And then also in our website, there'll be data there as far as the population and the per capita income, how many dollars people spend. So hopefully the Economic Alliance can be partners with the City of Kankakee to promote the Opportunity Zone and continue to get Opportunity Zone money invested in the downtown Kankakee. And that's our contact information. You'll get copies of all these slides, our contact information, in case there's any questions that you've got in regards to any of the things that we talked about here today. So thank you very much, and I'll turn it over to Scott.
Thanks, Tim. I think a couple things that we heard today that resonate is, number one, the Opportunity Zone was created out of a need. There's a need for housing in Kankakee. There's a need for multifamily housing in Kankakee. There's a need for affordable housing in Kankakee. With the Kankakee Riverfront development that I have some involvement in, and we're certainly fortunate to have a wide range of folks that work on the Riverfront implementation team. But we know that this will be a destination location, not only for Kankakee, but for those coming in from afar. And I'm excited to see what that'll look like, 5 to 10 years from now. But again, we're in a renaissance, as Tim spoke, with all the jobs that are coming to town. We seem to be a destination location for employers, which is great. We're very fortunate to have that. Now we need to focus on being a destination location for people to live here. And we can do that by building the infrastructure that we need as far as housing and amenities for folks to want to be able to stay here. So what I'm going to talk to a little bit about, like I said, my name is Scott Snavely. I'm with Midland States Bank. We're fortunate to have many longtime banks in our area. Midland States Bank is no different. We've been around since the late 1800s in Effingham, and we have a strong presence in Kankakee. But I'm going to talk a little bit about some of the financing stacks. So opportunity zones that come in don't necessarily always finance 100% of the projects. And if you're looking for bigger projects, what does that financing stack look like? So the first stack I have is really actually kind of basic. So you've got a $10 million request. That'd be a sizable project, whether it be multifamily housing or a hotel or something along that line. Normally you would have an owner put in as much as 30% injection before the bank kicks in their 70% financing. In this particular case, we're looking at $1,000 owner's equity being put in, $1 million owner's equity coming in, $7 million of Opportunity Zone funds coming in, which would probably be at a cheaper rate than a loan would be at this point in time, and then Midland State Bank, that being the other 40 or 20%, which would be the $2 million. So again, Opportunity Zone funds can be used as a huge resource to be able to leverage being able to finance projects. One thing that I did not put on up there that I wish I would have, but I do want to acknowledge this. I know there's couple banks in the area that do small business or SBA financing 504 on commercial properties. So normally the way that works is if somebody comes in and says, I want to build a $10 million project or whatever, and I'm going to use SBA 504 financing. So the SBA normally would require them to put 10% down. SBA finances 30% of that. The bank would come in and finance 50 or 60, or excuse me, they would put 20% down. SBA would finance or do a debenture for 30% of that, and then the bank would do the remaining 50% of that. With the opportunity zone, from my understanding, is the SBA does not require an actual cash injection from the owner. They can actually use that opportunity zone as 20% of that equity injection. And then again, with the SBA doing the 30% and the bank doing the 50%, there may be little that the actual owner has to inject themselves. So again, just great tools to be able to finance projects. A couple of other things that fall into that financing stack could be job creation incentives, tax increment financing, new market tax credits, EB-5 financing, which is a new thing that has come out that can be used as an equity injection, and then, of course, traditional financing. So the example I had here was actually on a $20 million project where land and or cash was $1 million injected. Opportunity zone was $4 million or 20%. The SBA 504 was $5 million or 25%. That's their normal cap, $5 million. And then a bank loan or Midland States bank loan of $10 million, making a total of a $20 million project. So we're fortunate that we have the ability to be able to go up to $10 million or more on some of these projects. And if we have a developer that wants to do multiple projects, because there's different revenue streams coming from those, we can even go a higher amount than that. So we're looking, obviously to be able to utilize that as well as other bank resources to be able to finance and fund some of these projects. One other thing that we have, I think it kind of is a little bit of a differentiator. I'm going to go over just a couple of the products that we have that obviously many of the other banks have. So somebody comes in, they want to finance a building or whatever. Obviously we can do office, industrial, warehouse, senior care facilities, hotel, motel, gas station, car wash, C-store, the ability with SBA, and then FHA with love funding I'll talk about in a minute, and then also to be able to leverage TIF funds as a way to lend against that, because sometimes the TIF funding stream is over a 7-year period, but that developer actually needs that money up front. And then obviously if somebody decides they want to build a new building to run an operation out of, they're going to need some equipment. So we have the ability to do both. We can either lease or finance equipment. We've done in many cases a guidance line for multiple periodic purchases. So somebody says, I want to buy 5 different pieces of equipment over the next 12 months for $1 million. We'll approve that person or that entity for $1 million, and then we'll slot those purchases in underneath that as a separate transaction. We can do fleet vehicles or whatever for the business, construction equipment, medical equipment, computer and software, and then as the other banks can do, we do lines of credit for working capital and cash flow, especially if the business is seasonal and there's kind of an ebb and flow in their income and their revenue. But the one thing I want to talk about as well is Midland States Bank is fortunate to have a funding arm that we actually own called Love Funding. They do some very big projects that are mostly HUD-backed. They can do loans up to $47 million. We have a lot of experts in Illinois where our footprint is, but these projects can actually be done throughout the United States because they are FUD-guaranteed loans. As you can see, the primary projects that we look at to do these are multifamily, healthcare, and hospital. We provide refinance, acquisition, construction, rehabilitation, and then bridge loans for market rate multifamily and affordable housing communities, which is also well known as workforce housing, healthcare facilities, and senior housing, as well as hospitals. Just in the last 2 years, Love Funding's closed nearly $1.8 billion in HUD-insured financing for valued clients. Why is this important? The benefits of having FHA or HUD financing, number one, they're flexible. Sometimes the down payment that's needed to do these projects is less. The debt service coverage ratio is less than what would normally be required. But what's really impressive is the fixed rate interest rates that can be locked in for up to 35 years on a new construction. It's the other way around. It's locked in for 35 years on an acquisition refinance, or it can be locked in for 40 years on a new construction project. That's significant when you're doing a big multifamily unit development or a senior housing project or affordable housing project. While we can do bridge to HUD, meaning that we would do the construction financing, get it ready for HUD, have HUD come in and do all their inspections or whatever, we would normally do that as a recourse up front, meaning that The guarantor would have to guarantee the loan, but once we have it taken out to HUD, it would be a non-recourse guarantee, so the loan would be made to the entity only, and that's big for business owners that don't want to have, to sign up themselves for that. They can be fully assumable FHA loans, providing they're approved by FHA. Long-term amortization, again, 35 to 40 years. Then the flexible repayment structure, and then as I mentioned, the bridge loan program. Platform Love Funding offers a bridge to HUD loan platform as an interim financing option when quicker executions are required to do HUD regulation dedicated to and a need for interim financing. And then also, and there may be some out here that might be familiar with this, but with affordable housing or workforce housing, there's also a thing that's called low-income tax credits, which is something that we're involved in. We either buy those directly or we syndicate those, but those are also another way to leverage financing and funding for affordable housing as well as workforce housing as well. So we've got a lot of tools in our arsenal, and I just want to let everybody be aware that, regardless of the size of the project, that we have the ability to be able to do those. When we send out the PowerPoint, I'll have my contact information on there, and then Brett Frank is our local Love funding representative, and he can answer any questions you have regarding the structure of that. So I appreciate the time and everybody coming. It is with great pleasure I'd like to introduce Linda Crane from Protagonist Capital. I met Linda at another event and was just very, very impressed with the work that Protagonist Capital, her organization, she's a managing partner, and all the great work they do, and certainly the intelligence that they have around how everything works with an opportunity zone and how those programs work. So thank you, Linda. You bet.
Good morning, everyone. Thank you. I may have missed the instructions on here. Thank you. And can I just type in a number to go to a slide too? Okay, thank you. Thank you very much for coming out, and I'm so happy to be a part of this program. I have just come off of 3 days of meetings with the new executive director of the White House Opportunity and Reinvestment Council, and I want to spend some of my time talking about what happened during those meetings and what I can share about what happened in those meetings. It may add to what I was going to talk about instead and what other people have been talking about, just as an update. So I'll start with just encouraging everyone to continue investigating and studying what's going on with the Qualified Opportunity Zone that came out of the Opportunity Investment Act. And it is, of course, a tax shelter at the initial description of what it is about in terms of policy. But it turns out that there's a great deal more to this. When my partner and I were first getting acquainted with the new legislation and decided that this was an area that we really wanted to pursue as a private equity firm. My partner has a great deal of experience in EP5 and some other alternative financing solutions, and I'm a lawyer most of the time, at least up until about 9 months ago, and now I'm an entrepreneur in this space at least equally to the amount of time I spend on my law practice. And it is something that is very compelling. But from the very, very beginning of our discussions about the new private equity firm that we were launching, we started talking about the community impact. And it just seemed unlikely to me that the opportunity zone, which was only part of the policy that had been even formally given a name at that point, that it just seemed strange to me that the Opportunity Fund legislation, even with respect to the tax shelter, was referring to the opportunity for wealthy real estate developers to get wealthier by coming into poor black and brown communities around the country and rural areas. That did not make sense to me. even just the name, that would just be too larcenous, right, to just call it, this is Opportunity Zone Fund for that purpose. But when in our meetings with other business people around this, that was what was always expressed. Well, this is just another real estate development investment incentive with a tax gains savings that is intended to lure the money into these zones as designated based on the 2010 census tract data that the governors looked at and sometimes delegated to mayors and other people in the states to identify these zones. There are about 8,700 of these zones around the country and in all of our territories and Indian tribes. And it turns out that there is a lot more to it, that the tax policy is really just one of three major pieces of activity, both legislation and executive orders, that together make up the Qualified Opportunity Zone policy. There's the tax shelter, which does, in fact, lure money into the zones, precisely as everyone has said already. And it's a very strong magnet for money. There will be trillions of dollars pouring into these opportunity zones over there in a relatively short period of time. And so to that extent, though, that's the carrot that is being used to entice money that would not normally go into the zones to come into the zones. And that's how economic revitalization can occur. Great. That is the goal, revitalization. But the other two things that have also now come online are both related to community inclusion and protecting interests of community residents who currently live in places that are now being designated as zones. All right? And the first of those two is the First Step Act, which is the new criminal justice reform legislation that was passed late last year that results in some reform of sentencing for convicted felons who are spending time, who are already convicted felons, often still in prison, whose sentences are being reevaluated, and in many cases, at least in some cases already, and more, they're being released from prison after their sentences are being recalculated, and they're now considered part of this community in the zones who the revitalization is intended to help as a part of attracting the money that would not normally come into the zones. All right? So it's not disconnected from the communities where these zones are. It's not just only about the tax shelter, but it's also about the communities where those shelters are going to be made available as a result of attracting the money that would not normally come there. And yet, at the same time, I said, well, where's the money for this? So if we're going to protect the community, if we're defining it broadly to even include ex-convicts, which is a failure of many previous programs that have been in existence saying that they were there to help make sure that there was community inclusion at the same time that the investments were being made by either outside money or inside money or government money. What is this community? So the community, I feel very good about the fact that it's being defined so broadly. Obviously, it's not only for people who've been released from prison early, but people who've been released from prison early have families, they have children, they have mothers, they have siblings, they have disabled adult children and siblings. They've got pressures like the rest of us, and with the pressures that we deal with without the yoke of having been in prison around our necks, we find difficult to deal with. Imagine what it is for them. So again, I'm really surprised and pleased. If any of you watched, and I find myself in a very odd position of, as some of us, I think I'm not the only one, of sort of being surprised by something like this coming out of the current administration, but this is where it's coming from. Now, there have been some incentivizers there. It was obviously Tim Scott was one of the key proponents of this legislation, and President Trump asked him what he wanted, and he said, "This is what I want." And this got bipartisan support. So for those of us who are wondering whether this will continue, actually the vast majority of the features of this whole policy are much more in line with what Democrats are normally known for than what Republicans are normally known for, and especially maybe the current president are currently known for. That's all to say that there's a good reason to think that it will stay in effect regardless of who, is in the White House over the term of this period, which is a relatively finite period as it is. The third part of the three-part policy is this new White House Opportunity and Revitalization Council, which is chaired by Ben Carson, the Secretary of Housing and Urban Development. It is a result of an executive order that was signed by President Trump late last year. And the purpose of the council, there's 16 members, 13 federal agencies, and 3 state partners. And the purpose of the council, they have said, is to help to coordinate the activities of various federal agencies that already have programs in place, grants that can be applied for purposes of, that many have already been mentioned here today, in terms of stacking programs, stacking grants. Meetings in our meetings this week, the regional representatives of HUD, EPA, SBA, Commerce. We even had the chief lawyer from Treasury call in to answer questions some people still had about that after the last round of regulations were released. He did say, for instance, that the rumor that the 12/31/19 deadline might be extended is not true, that there is no plan for that. So don't delay. And that there is no plan currently for any new zones to be added. Because as we know, because these zone tracks were based on 2010 data, when we look at the current makeup of a lot of the opportunity zones, they don't really look like the places we would expect them, they don't look like we expect them to look, because a lot of those places have already become gentrified over the last 9 or 10 years. And the zones were based on the economic data from 2010. So a lot of questions have been asked about, well, why don't we just add additional zones? And I don't think that that's out of completely out of the realm of possibility. But the zones that have already been created will not change for sure, because that would require statutory change. But it is, and I don't think it's really possible or likely that additional zones will be added, but it is possible. I had hoped that when I met with the executive director of the council, and I brought together groups of business stakeholders and nonprofits and community organizations, and several other groups of people, to sit down and talk with him. And it was very, kind of straight, tough talk. And I told them that I was going to be reporting to the group at Kankakee Public Library today on everything that we talked about, or as much as I thought was relevant. And they were supportive of that. The bottom line is that in order to take advantage of the so-called efforts of the council to help with providing additional financial support for investment funds and qualified opportunity zone funds, obviously, they have to be inside of a zone. They have to be inside of a qualified opportunity zone. This is one of the biggest challenges we have with our clients at Protagonist Capital. Is we take a very much a bottom-up approach. We like to find a good idea that we think will be successful if placed in the right place, and then we choose the place. But our investors are only interested in investing in opportunity zones. And some of those investments will be in industrial areas, some will be in suburban areas, some will be inside the city. But the main thing I would say, if you don't take anything else away from this, is you give yourself time to get up to speed with what's going on with all of this. Just remember to place the business inside of a zone. Right, to make sure you know what the geographic boundaries are of the zones near or in the areas that you're thinking of. Because jumping the gun in this case means putting it into a location that doesn't qualify for the tax shelter at all. And then you can, you can qualify for TIFs and, other types of programs, but they may or may not be as sensitive to location as the Opportunity Zone tax shelter will be. So that's really important initially to do that. The comment period for the current regulations is expiring on July 1st, 2019. The second round of regulations came out a couple of weeks ago, and as was described earlier, they did clarify some of the things that were not quite as clear before. As a result, there does seem to be greater basis for optimism on the parts of people who want to start operating businesses as qualified opportunity zone businesses. Prior to the second round of regulations, there was a strong sense that, again, there were fewer, I think, risks associated with real estate development projects. And because there were fewer risks associated with that, there were more questions that needed to be answered by the second round of regulations. A lot of those answers did come out, and one of the big questions was whether you could tack your holding periods of operating businesses to add up to the 10-year holding period the way you could, add 1031 to a shorter holding period for a real estate investment firm. And the answer that they said clearly is yes. And of course, operating businesses are the ones that really add a lot of energy and vitality very often to communities. Obviously, that often comes with real estate development as a part of it, especially, hotels and affordable housing and things like that. Workforce development is another big thing with respect to ex-convicts. Very often have serious housing problems. HUD is actually taking a key lead role in this, but my main message is that if you are concerned about, if you'd like to maximize the value of the work of the White House Revitalization Council to the extent that it can help with achieving certain goals in the community, that their message to us was that it's very much a private-public partnership. It's very, very local. They are not really sending new money to the zones for this. What they're doing is encouraging coordination of all of the existing grant proposals that the existing federal agencies already have. And so it would behoove us to attract capital and also to encourage or incentivize entrepreneurship within our communities that can really benefit from SBA relationships and things like that, to streamline that process or provide information that's easily digestible and accessible that provides would-be qualified opportunity fund investors to easily know how to stack those federal programs or how to just easily take advantage of the relatively uncomplicated qualified opportunity zone tax shelter, which is something that's very attractive to wealthy individuals and family offices, as well as real estate developers and a lot of other people who tend to be a little more mission driven. And make comments before July 1st, so the comment period. The council is to get together and figure out what those comments should be. That you know what the agencies some of the shortcomings are of some of the current projects and current federal grant projects or grant programs. Well, now's the time to communicate to Washington what about those programs. Now that they're telling us to work together with those existing federal programs, if we know that those existing federal programs have weaknesses that don't seem to be consistent with what we're saying these new objectives are, then point out what those weaknesses are and suggest that those be changed. Now, the comments, of course, go to Treasury Department for potential changes to the regulations. I've been told there's a good chance there will not be a third round of regulations, even though there's a second round of comments, and that those comments might just be incorporated into best practices or policy or something to sort of see whether there's something that really rises to the level of a requirement for additional changes to the regulations. We could also make comments to the council regarding those kinds of changes, though, that could be directed to the other agencies other than Treasury, which is where the tax regulatory comments would go, and get the buy-in of your local officials, your mayors, your county officials, the governor, and see if they'll help with endorsing some of the changes in the comments that you'd like to propose, and locally put together a portal of information online that someone who's interested in Kankakee or heard about Kankakee and is really impressed with you're close to Cook County, but you're not in Cook County. You got all these things about Kankakee that, you could talk about, and make it easy for people to find. And there are cities and states we've been told that are really taking the lead on that you could probably identify, or I can help you if you wanted to ask me. So I don't think this is exactly what I was asked to talk about, but I don't think I had a whole lot more to add to what everybody else had said other than this, so thank you.
Well, thank you very much. And can we give a round of applause to our panelists again for taking time to inform us on some of this valuable information. We do recognize that time is far spent, and we have a couple of housekeeping things I do want to point out. Number one, I did forget one of our former alderwomen who is in the crowd here, Ms. Gloria Kennedy, so I wanted to recognize her. Also, I would like to take a moment to recognize the Key City Community Development Corporation's Board of Directors. If you all, wherever you are, please stand. We've got Pastor Crawford here, Barbara Wells, Monica Pisano, Dave Barron, myself, and Barbie Brewer-Watson in her absence. So if we could give them a round of applause for the work that they're doing to try to benefit the city of Kankakee. Thank you so much, Key City Development Corporation. With that, I would like to invite everyone, hopefully you have your umbrellas. Grapes and Hops, Terrence, the owner there, has graciously invited us all to gather down there for further conversation and for any questions you may have of some of our panelists who can make it. Not everyone can make it, but those who can, we would like to do that as well. Also, I would like to ask you to please, there are some sign-in sheets on some of the tables, and there are sign-in sheets available at the table that you walked in on, that you would please sign in. We will get these PowerPoint slides to you via email if you're interested. So we would like to have that information to you. Q&A, we had planned Q&A, but I think we may be a little bit beyond that point unless there are maybe 2 to 3 questions that you're burning to ask. Otherwise, we will consider this the conclusion of the event because we do want to be respectful of your schedule as well. If you can join us at Grapes and Hops, please feel free to do so. Otherwise, thank you so much for being here. We thank the library, the City of Kankakee, all of our sponsors, Midland, the Economic Alliance, and the Kankakee County Chamber of Commerce for making this event possible. So thank you very much for being here. Have a wonderful day.